Hello, and welcome back to Livewire's Alternatives in Focus series for 2024. I'm Hindsight. It is great to have you with us. Joining me today, Steve Bennett of Charter Hall. We're going to be discussing his insights into investing in the property markets and what investors can expect over the next 12 months. Hey Steve, welcome to you. Thanks for joining us.
Yeah, pleasure to be here.
Let's start with that big picture. It's been a difficult few years for property markets. Least of all, I need to tell you that. Higher interest rates, higher debt costs, high construction costs, worsening investor sentiment. It seems like a laundry list in a way. But where do you think we are now in the property cycle?
Yeah, look, as negative as that sounded, it is probably a fair summation of some of the challenges since we saw peak valuations in June 22. And that was peak valuations across most of the commercial real estate markets. The good news is that many of those headwinds are behind us. So we saw across many of the assets, office, industrial and logistics, cap rates increase around 180 basis points since that June level. And cap rates work just the same way as bond pricing. Higher interest rates mean lower bond prices, higher cap rates mean lower real estate valuations. So we do think we're approaching the bottom in certain sectors. We think some sectors, such as industrial and logistics, convenience, retail, we've already hit bottom in terms of the June 24 valuations. There's probably a little bit more uncertainty around office and whether the December 24 vals will come off a little bit more. Regardless, what it is fair to say is that if we haven't hit the bottom, we're very close to being there.
Let's actually pick up on that theme then and kind of expound on that. Where are valuations today compared to history, as you say, if we're through the downturn, through near the bottom, is what you're saying?
Yeah, look, one of the benefits of the Charter Hall Group, we own over 1,600 assets across all the key commercial real estate sectors. A little known fact, we're the largest owner of real estate in Australia. What that means is we do get great data and insights into the trends around valuations, what people are paying for assets. We see everything in the market. What we saw for office and industrial logistics is cap rates since that June 22 peak have increased around 180 basis points. So 1.8%. You've seen retail, so the bigger malls, around 100 basis points. But the difference in the valuation side is certain sectors, such as industrial, have benefited from mid-teens rental growth per annum over the last 12, 18, 24 months, which has largely offset a lot of that expansion in cap rates.
When that recovery comes around, or when it starts, when interest rates start to come down, as you say, how do you think the pace of recovery across the different areas of the property market will vary?
Yeah, look, it's a good question because people often assume that the whole real estate sector moves as one. For many of your audience who are very familiar with equity markets, you'll know that a BHP will perform very different to, say, a Telstra or a Woolworths in terms of the pricing. The same goes in real estate. We think in the office market, it will very much be a two-tiered market. So the highest quality, prime grade assets will come out well. Supply will be quite muted. It takes 8 to 10 years to build an office building like we're sitting in here in a CBD market. So the supply response will be very slow. In terms of industrial assets, we think they will come out of it quicker than some of the other sectors. But even in there, we do believe that the longer leased assets, which have been a little bit out of favour in the industrial and logistics market because when you've had that very high rental growth, people have preferenced shorter leases. We think that will swing back where people will value the long-term certainty and the quality of those cash flows in those prime industrial assets that you can say leased to Coca-Cola, your Woolworths, your Coles. We think they'll come out quicker than, say, some of the secondary industrial.
Yeah, of course. And the longevity of leases is very important in property. So let's put this all together then. Where are you seeing your greatest opportunity, your greatest risk reward with all of this in mind?
Look, there's a couple of pockets. And as I said, you do need to be specific and targeted. And we do get the benefit of 600 real estate professionals across the country scouring all opportunities. If we start at the listed space, we still see value in the listed REIT stocks. They've had a strong run the last 12 months, but that's largely been heavily influenced by one stock, Goodman Group. We're still seeing around 9 to 10 stocks, which we think are around 15 to 30% below their intrinsic value. So we like that, a good liquid way to play high quality real estate. Industrial logistics, as I said, we think that has bottomed. We think the big institutional investors will once again try and increase exposure. And this may surprise some in the audience, pockets of the office market where you can get outsized returns and almost opportunistic returns, but from core low risk office real estate.
Okay, well, you mentioned stocks, so I've got to ask the question. When you talk about those stocks, they're trading at a discount compared to companies like Goodman Group. So, I mean, do you dare say that a company like Goodman Group, maybe a lot of that optimism is in the price? And if you dare have a crack, which of those stocks trading kind of like an intrinsic discount, if you like, or a discount to where it should be, which ones would you be backing?
Yeah, look, I think it'd be a brave market participant to put any negatives on the Goodman stock. They've had, over long periods of time, stellar growth levels, but they are now 39% of the A-REIT index. So that level of concentration means that we think there's some opportunities that have been overlooked. One of those, I would say, Dexus. As we sit here now, Hans, it's around $7.50. It's got a $40 billion funds management business, basically priced at nothing. The assets are trading below where we assess independent valuations, as well as the Dexus management and what they're telling us the valuations are. We think a realistic medium-term price target for a stock like that is around $10.50. So from a big, large, diversified manager, that's a great level of potential upside.
Okay, Dexus, we'll all be writing that one down. So that's where the best risk reward lies. Naturally, we have to ask the flip question. Are there any REITs, assets or stocks, whichever way you want to take this, are there any REITs that you think could continue to suffer even while others are already in their recovery phase?
Look, as a general rule, the REITs with a lower quality stock that haven't positioned their office assets into that prime grade, we think the rebound could be very patchy for them. There's a couple of stocks that have stock-specific things that need to happen. I'll give you an example. I'm not saying it's got trouble or anything, but something like a Cromwell, where they've got a large European transaction due to settle in Q1 next year, we'd want to see that happen before we'd reevaluate that stock. Some other REITs have big exposure to the mining sector, indirectly in most cases, but that would mean we'd want a little bit more clarity on what's happening with commodities, the China situation. So, look, what I would say though, the market is actually worn a lot of the downside. If we're having this discussion 12, 18 months ago, it'd all be about increasing interest rates, lower transaction volumes, rebasing of earnings, valuations coming off. Pleasingly, we think most of that's behind us. So it is a good risk-adjusted point in time to potentially enter the market.
Steve, I know your background covers unlisted as well as listed assets, so I really want to touch on your unlisted expertise as well. When you are looking out for new assets, new projects to get behind and to put some cash into on behalf of clients, what are the kind of like the telltale characteristics that you look out for as markers to invest in? And I guess as well, are these different across listed and unlisted assets as well?
Yeah, look, the listed market tends to respond quicker, but does come with more volatility. The unlisted space, you just got to stick to the basics. For the last couple of decades, in a generally falling interest rate environment, that did a lot of the heavy lifting. We think it's really going to come down to active management now. You've got to grow the cash flows at your underlying assets, and that will ultimately lead to higher valuations. You need to do your research, pick your markets. So office, for example, people often are a little bit negative on that at the moment. Understandably, it's been most impacted by the COVID lockdowns. But even within Melbourne, if you look at something like the Paris end, that's a very different office market than, say, down in deep Docklands. So we do see some opportunity in prime grade office where we believe the valuation impacts have been overdone. We've always focused, Charter Hall as a group, on high quality tenants. We've now gone through the fastest level of interest rates in a generation, and we've had across our platform $65 billion of real estate, almost no tenant defaults. And that is because we do a lot of work up front, picking the right assets that can attract the top tier one tenants, and we lock them in on long-term leases. So we do think as we now move into the growth part of the cycle, those stability, high quality cash flows will once again be more valued than, say, some of the shorter leased assets where the market tended to reprice be less discerning, let's say.
Okay, no, fair enough. All right, so just to summarize those characteristics there for the benefit of the audience, geography is obviously important, vacancy rates, tenant quality, tenant lease, no doubt valuations and yields. So putting that all together then, could you maybe take us through a couple of examples of those individual unlisted opportunities that you like and why you like them?
Yeah, look, I think the industrial and logistics market, the institutional capital is coming back asking a lot of questions again.
Sure.
So if I turn my mind back 3 or 4 years, there was a big scramble throughout the globe to get set and upweight into that industrial and logistics part of the real estate sector. We do think that will continue to be the case. As we sit here now, we're receiving unsolicited offers for a number of our industrial assets at premiums to book value. So that's changed dramatically. We've also seen the transaction volumes in that space already rebalance back towards long-term averages. So in the near term, I think high quality industrial and logistics, the growth rates for rent will come back. It's not sustainable 15, 18% rental growth. But if you can have high single digit, low double digit for the next 12, 18 months, that's going to position portfolios quite well for investors to pick up some further valuation growth.
Okay, let's tie this all together, Steve, just to finish this up. How should investors be thinking about their allocation to listed and unlisted commercial property in their portfolios? And I guess when you talk to your investors and to your clients, how much do you find they tend to typically allocate of their portfolios in, I guess, percentage terms to REITs and property?
Yeah, look, the first thing I'd say is we're agnostic. Whether you choose to access high quality real estate through the listed market, which has daily pricing, full liquidity, but with more volatility, or the unlisted space, I don't think it matters. It really is going to come down to making sure the investor understands. So the unlisted funds are great, lower correlation to big sectors such as Aussie equities, offshore equities, but you should put them in the illiquid part of your portfolio. The income returns for unlisted property, 5 to 7% long term, total returns 9 to 10%. The allocations are interesting. It tends to vary, and some groups bucket it in with other types of alternates, whether it's debt, whether it's PE. But a common allocation is somewhere between that 8 to 15%. We know plenty of high net wealth and wealth groups out there and individuals where it sits around that 20 to 25%. And the mix should be depending on what suits their liquidity profile. So I'm mid-40s, I've got a longer investment time frame. A big chunk of my self-managed super fund is in unlisted real estate because I don't need the liquidity and I like the regular income.
Beautifully explained. Steve Bennett from Charter Hall, thank you very much for joining us. Great to have you on.
Thanks, Hans.
And thank you for joining us. You can catch more of the Alternatives in Focus series on our website, livewiremarkets.com, as well as our YouTube channel. We'll see you again soon. Take care.